Imagine a country transforming from a development case study to an economic powerhouse. This is the story of Bangladesh, which has become one of the most remarkable and surprising success stories in Asia in recent years. But can this incredible growth story continue, or are there hidden vulnerabilities that could threaten its future? Let's get straight into it. The division of India resulted in the establishment of two separate dominions, India and Western East Pakistan, which encompassed present-day Bangladesh. For more than 20 years, the predominant Bengali populace in East Pakistan was governed by a central administration situated in West Pakistan, which primarily allocated resources towards its own advancement. Bengalis felt aggrieved by the perceived deprivation of their rightful share of economic resources in Bengal. Despite the devastation caused by the War of Independence, it contributed in certain aspects to Bangladesh's journey towards prosperity. Numerous expatriates returned to assist their fledgling nation in its recovery. Organizations such as the BRAC made a different impact by focusing on women. By the 1990s, BRAC operated 64,000 schools, not only educating girls but also employing women as teachers. Presently, there are more girls enrolled in high school than boys, a notable difference from India and Pakistan. BRAC and similar groups also popularized microcredit, enabling millions of rural women to become entrepreneurs while maintaining essential social expenditures. Bangladesh's economic growth is largely attributed to its success in garment exports. Today, Bangladesh ranks among the world's largest exporters of ready-made garments, with the RMG sector contributing 85% of the country's exports and 9% to its GDP. This sector provides clothing to renowned global brands, and a significant majority of its 4.4 million employees are women, 60 to 70%. This represents a substantial empowerment, especially in a country where alternative employment opportunities are limited. Approximately 80% of Bangladesh's foreign exchange earnings are derived from the garment sector. Moreover, around 10 million Bangladeshi nationals employed abroad send back $15 billion annually as remittances, constituting another substantial portion of the national income. By 2021, Bangladesh's foreign exchange reserves had reached a record high of $48 billion. The main catalyst of this growth is investment, which has increased from 24% of GDP in 2000 to 32% in 2022, considerably higher than Pakistan's 13%. Productivity growth has remained minimal, hovering below 1% annually since 2000. Bangladesh exhibits lower productivity levels compared to India, Indonesia, Pakistan, Vietnam, and China, a key factor influencing long-term income growth in all these countries. Despite grim expectations, Bangladesh has actually made notable strides in poverty reduction and economic growth, despite facing military coups in 1975, 1982, and 2007, as well as a series of natural disasters. It has notably enhanced its prospects, even surpassing India in terms of economic standing, at least when measured on a per capita basis. However, upon closer examination, there are concerns regarding the quality of this economic performance. First, there is a significant reliance on a single category of exports, apparel and clothing, and a low proportion of exports to GDP. Contrastingly, a country like South Korea successfully diversified its exports base away from resource-based products, garments, and footwear within a span of 15 to 20 years, starting in 1963, and emerged as a stronger exporter of sophisticated goods such as steel, machinery, chemicals, transport equipment, and consumer electronics. In contrast, Bangladesh continues to concentrate on a narrow spectrum of relatively low-value garments, even after more than 40 years since the industry's inception in 1977 to 1982. Although Bangladesh's ready-made garments RMG sector continues to be a major exporter to Europe's fashion industry and has significantly increased its market share over the past decade, this trajectory may not persist. The newly established preferential trade agreement between the European Union and Vietnam could potentially result in Vietnam's apparel exports outpacing those of Bangladesh. Within the realm of US apparel importers, Vietnam has consistently surpassed Bangladesh's ready-made garments industry. Vietnamese apparel imports into the US have been valued at 2.5 times more than those from Bangladesh. As US buyers shift their sourcing away from China, Vietnam emerges as the primary beneficiary. Bangladesh's share of exports in GDP has declined since 2012, dropping from 20% to 12%, significantly lower than Vietnam's. Furthermore, Bangladesh's Economic Complexity Index, which gauges the productive capacities of large economic systems, has declined from 77 in 1991 to 101 in 2021, in contrast to India's 41 and Vietnam's 54. While Bangladesh's success in the ready-made garment sector is noteworthy, over-reliance on a single industry for the majority of export earnings poses a risk. To sustain economic growth in the current global environment, Bangladesh must enhance the competitiveness of several other promising sectors to diversify its export portfolio. Efforts are being made to diversify trade in areas such as light engineering, plastics, leather, and footwear. However, companies must elevate their standards to meet the international benchmarks in order to compete effectively on the global stage, a challenge they often struggle to overcome. While Bangladesh has made efforts to expand into the pharmaceutical sector and can fulfill a significant portion of the domestic demand, its export earnings were only $169 million in 2021, albeit with a growth rate of 21%. The required diversification process is hindered by the lack of private investment in emerging industries, a challenge exacerbated by constraints on access to credit, particularly for small and medium enterprises. Since 2020, global macroeconomic shocks have been severe, including disruptions to supply chains caused by the pandemic, extreme weather events, geopolitical tensions, and the Ukraine-Russia conflict. These challenges have been particularly difficult for countries in the global south, like Bangladesh, which have fewer financial resources and lower economic resilience. In the first half of 2023, the International Monetary Fund (IMF) approved a $4.7 billion loan requested by the Bangladeshi government as a stabilization package, distinct from the bailout packages sought by Sri Lanka and Pakistan. Although Bangladesh is not currently experiencing a full-blown economic crisis, the country must learn from various experiences to address the underlying challenges and rectify structural weakness in the domestic economy. The concentrated manufacturing sector of ready-made garments that drives Bangladesh's economic advancement poses risks of homogeneity for its export portfolio. Not only is this sector vulnerable to fluctuations in global demand, but its production heavily relies on unskilled laborers working in unfavorable conditions. While the service sector typically complements the RMG industry, it also offers a sustainable long-term alternative to the export mix dominated by RMG. Bangladesh's tax administration is plagued by corruption and suffers from inadequate revenue generation. The inadequate state of transportation and energy access, coupled with recent increases in input costs, has hindered numerous infrastructure projects and exacerbated budget deficits. Implementing more robust anti-corruption measures alongside structural initiatives for revenue augmentation and expenditure optimization is imperative. The decline in ready-made garments exports, along with increasing import bills for essential commodities like food and energy, coupled with the direct impact of fiscal deficits, has worsened the current account balance. Reduced foreign direct investment, primarily due to an unfavorable business environment, has also affected the capital account, bringing balance of payment issues to the forefront. Addressing this requires export promotion strategies and reducing Bangladesh's reliance on imported inputs. Additionally, various macroeconomic indicators have been affected by recent global events, including a decrease in remittances, depletion of foreign exchange reserves, and currency depreciation, raising significant economic concerns. Bangladesh must take prompt measures to stabilize its economy, complemented by adequate social safety nets to safeguard vulnerable segments of society. And the problems are far from over. The energy sector in Bangladesh faces a significant demand-supply disparity that requires attention. Implementing technological advancements and accelerating the shift towards renewable energy sources can help bridge the gap in energy demand without hindering domestic economic activities. Moreover, recent inflationary pressures, driven primarily by escalating food and fuel prices and exacerbated by the Russia-Ukraine conflict, present short to medium-term trade challenges. This underscores the need to enhance domestic capabilities and expand global partnerships to bolster economic resilience. Bangladesh faces significant vulnerability to the impact of climate change. According to the 2021 Global Climate Risk Index, Bangladesh ranks as the 7th most affected country by extreme weather events. With its low-lying terrain, rising sea levels pose a threat of displacing an estimated 15 to 30 million Bangladeshis residing in coastal areas. Unplanned internal migration to urban centres, coupled with ineffective governance, could exacerbate the situation, leading to the proliferation of hazardous slum settlements. In contrast to Sri Lanka and Pakistan, which grapple with heavy external debt obligations, Bangladesh's situation differs. With an internal debt to GDP ratio of 11.87%, well below the IMF mandated threshold of 40%, Bangladesh is not burdened by significant external debt servicing commitments. However, substantial efforts are required to stimulate savings and investments to foster robust economic growth in the future. However, Bangladesh's banking sector is experiencing significant instability. The country's largest private bank, Islami Bank, had to request financial assistance from the central bank to restore depositor confidence. This situation primarily arose due to loan frauds involving influential business groups and individuals associated with Islami Bank. Many other banks across Bangladesh encountered similar challenges. The ongoing banking crisis, coupled with capital flight from Bangladesh, as well as instances of cronyism and bureaucratic corruption, are deeply entrenched in the country's patronage-based political system. This situation has deteriorated over the past decade. Despite Bangladesh's advancements across various socio-economic indicators, addressing inequality is imperative to establish an inclusive development framework. Currently, early indications of an economic slowdown are emerging. A thorough understanding and reform of the structural vulnerabilities in Bangladesh's economy could pave the way for sustained economic growth and long-term sustainable development. Bangladesh also must remain vigilant regarding the threats posed by fundamentalism. With Prime Minister Sheikh Hasina's strong dedication to mitigating these risks, there is a cause for optimism. If successful, Bangladesh will embark on a trajectory that would have seemed unimaginable just 2 decades ago, progressing towards becoming a success story in Asia.